bring in David Kotok to comment on this. He is Chief Investment Officer at Cumberland Advisors. He manages about $8 billion in assets there. And David, you heard what Suzanne was just saying. We've watched, I think, 32 or 34 of the 45 major national indexes that we track go into bear market territory. That is a drop of 20% or more. Do you think it's justified?
Well, it was justified going into the area. Now the question is, how much more of this do we have? And if we don't have a double-dip recession, which I don't believe we're going to have in the U.S., then we are at an entry point. And in our shop, we think this is the entry point. Stocks are cheap, and they ought to be bought.
Stocks are cheap here. I mean, even with all the indications we're seeing that we're sitting on the edge of or slipping into a global recession again. I mean, you heard what Suzanne just said about copper. Gary Schilling will tell you that is surely a sign that things are not going to be good.
I agree with this issue about materials and coppers. In our positions, materials are at an extreme underweight. We only have a core position. So which sectors and where to go is important. But if you look at the S&P 500 index right now, the dividend yield from that index is higher than the interest yield on a 10-year Treasury note. You get paid more than the riskless to hold stocks, a very unusual circumstance. At the same time, if your time horizon is reasonable, if you're a day trader, I don't know what to tell you, but if your time horizon's reasonable, you can make a very good case for higher stock prices by the end of this decade. Our target is over 2,000, and you're going to get paid higher than the riskless rate while you wait. So stocks look cheap from a strategic view.
All right, so David, so stocks maybe by the end of the decade can gain, but talk to me about the next year or so. I mean, some of the problems that we look at, structural in nature, housing, we can't fix housing at this point. There's still millions unemployed. Companies aren't out there aggressively hiring at this point. How can we really move ahead in the market if we don't fix those problems? And they're not quick fixes, as you know.
They are not quick fixes. You're absolutely right, Carol. You've identified the issues. But those are old new issues. We could list those last month, the month before, 6 months ago. Let's talk about what we do know. We do know what the Federal Reserve policy will be for the next 2 years. That's now clear. 0 short-term interest rates, 2% in the intermediate term at 10-year, under 3% at 30-year. We have a predictable policy in monetary policy for the next 2 years. After 2013, Bernanke's term is up. We don't know what it'll be.
Right.
So for the first time, we have some resolution on the pricing of finance and the references for financial markets. We don't have the political mess resolved in Washington. It never will be.
Hey, but, you know, David, what about financials? I mean, most will say, you know, you can't get a sustained rally without financials. I don't have to tell you that they've definitely lagged this year. They're the worst performing group. Still lots of questions about the regulatory environment for financials. What's going to happen? Can we get a sustained rally, though, without financials?
Well, we need the financials to participate. We totally agree with that. We were underweight financials for 4 years. We are scaling that weight back up. I eventually want to take it above market weight because I think that's an entry opportunity, too. Now, financials, after 4 years, are reflecting all that we know that's bad, and none of what's good or none of what could come that is good. The entire banking system is for sale on the stock exchange below tangible book value. Now,
David, let me jump in and ask you, because it's along the same lines as this issue and also as equity versus debt. You do see a lot of companies obviously flush with cash. You see dividends being raised up all the time, which is why the yield is so much higher. At the same time, we had Marty Sass earlier saying he doesn't want to buy corporate debt because the default chance is so much higher, and we see Pfizer here getting downgraded, all the banks getting downgraded. I mean, isn't the problem that the risk is much higher in equities? Much higher?
Well, the question is perception of risk, actual risk. And those are two quite different things. Perception of risk about financials after 4 years of getting hammered is absolutely ugly. No one wants them. Isn't that the time to enter? Let's talk about the other side of actual risk. After 4 years of restatements, can't you believe an auditor now? They'd get shot if they misstated something.
David, we got to run. Great to get some time with you. You have a terrific weekend. David Kotok.